these are like colleagues across a globe dealing with very different countries and often very different situations, but who sharing information with helps you get better. So I'd say that's a very strong relationship. I regularly am interacting with them. We're about to go to our annual conference in August, hosted by the Kansas City Fed, and there'll be people from across the globe there, central bankers from across the globe, part of the talks, part of the discussion, and I find that a very rich and rewarding environment to learn from others and have them learn for us. It's just like rolling up our sleeves together and solving problems, even though we all come back and solve them for our own country. That's important. On our interactions with other parts of government, we've always been, the Fed and other parts of government, always been very cooperative and helpful to each other, but it's very clear we all have different roles. And you don't see at the staff level, even I'd say I'm a staff working with the head of something else, we're not trying to do the other person's job, we're trying to do our job better. So I would say that's a very healthy way to think about it. If you have role clarity, then you can exchange information and learn from each other without getting confused. And I'd say that's where we are at this point. But Fed independence is more than just something that we have and need to hold on to. It's historically been a very important thing to the stability of the role in economies in terms of keeping inflation and, in our case, full employment in the frame. But it's also a really important part of our integrity, right? The best tool the Fed has is trust and credibility. I say that, and I think we've got recent evidence of it. When inflation was printing at 7%, longer run inflation expectations hovered around 2%, which is our target. That's because people understood, even if they knew they didn't like 7% inflation, they knew we would get this down to 2%. So the 5-year ahead inflation expectations, 5 to 10 year ahead, it stayed at 2% or nearby. So I think of that as that's what credibility does for you. It makes the challenge of solving problems easier, and it also ensures people that we are on the job that we were given. Congress gave us 2 jobs, price stability, full employment. We signal that we're doing it, but that doesn't mean we have to cut ourselves off from the world. In fact, that would be the opposite of what we should do. We need to talk to people and learn from people, whether they're in our communities or other parts of government or other central banks, but we can't get confused about our role and the importance of sticking to our mandates and getting our job done.
Catherine, you have a question?
Catherine with Southern Pacific Bank. And first, I wanted to thank you, President Daly, for coming out here and making this time for us. My question is in regard to the labor markets, whether you see any disruptors on the horizon. And you had mentioned AI earlier in regard to Vietnam. Maybe that's one, but any high-level kind of disruptors that you see in the market?
Sure. So the labor market is in a constant state of being disrupted. I just wanted to say that, right? There's a lot of changes. There's an economist, David Otter, and he's at MIT, and he has a little diagram that shows that 10 years ago, 40% of the jobs in the United States didn't exist. I think I have that number right. But it is a very important reminder that the labor market is a dynamic place. And jobs that are here today weren't here a decade ago or 30 years ago or 20 years ago. It's just that's how the economy evolves. So there will always be disruptions. The pandemic was a big disruptor, and then people came back and they got their feet under them and firms got their feet under them and things. But what is always true is that the labor force needs to be agile in terms of their work. We have to, we say lifelong learning and things of that sort, but really you need to be able to move and grow as you move through your career. Otherwise you can be left when the technologies or the business lines change and move and you're not keeping up. So one of the things that I think needs to be disrupted, I'm going to answer your question a different way, whether it's technology or other things coming for the labor market, something that we could disrupt and make sure people were better is to have more what I think of as divisible education, where you don't get to 4 years and say, okay, that's it, I'm done, and then we don't have many opportunities to quickly retrain. And generative AI might actually help with that, because you're seeing small courses to become prompt engineers, small courses to be able to use the tools for data analysis. those are things that can help our workforce maintain its training so that it can grow and be ready for the jobs that are created. But I've done this work a long time, and I'm a student of history, and what I realize is the labor market's constantly changing. Sometimes the changes are big enough you can see them as they happen. Computers were one of those changes, computer revolution. More recently, generative AI, people talk about that as if that could happen. It certainly has the possibility, but I haven't seen it yet. So, but in any of these things, the best preparation for our workforces is that they continue to be able to advance their training, and in small enough bites to afford to do it and to want to do it.
Maybe Carl, did you have a question? Oh, I'm sorry. Okay, go.
Gwen Yamamurula, Hawaii Green Infrastructure Authority. President Daly, thank you so much. Very informative. So if I'm understanding how inflation is calculated this year over year, right? And
yes.
So if Google's correct, June 2024, it's 3%. 2022, over 9%. There's not many people I know that got a 9% raise in 2022. So where is affordability in the lens of the Fed's policymaking?
So our goals are very narrow, right? Price stability, full employment. But I can, and so that's what we're working on. It peaked at 7%, and it's a little under 3 now. The numbers we use, the PCE would be 2.6. So I look at those numbers and I say, that's a lot of progress, but we're not there yet. Now, when inflation was at its highest, real wages in the economy were falling. People were earning a lot of money, more money, a lot of money being more money than they were used to. Wage growth was rising, but it was not keeping up with inflation. And their real wages, adjusted for inflation, were falling. But then in the middle of last year, real wages started to rise. And that's because wage gains were still being made, but inflation was coming down. And real wages are rising right now. What happens in these inflationary periods is workers fall behind, and then it takes multiple years to catch up. And the piece that creates the ability to catch up is to have a sustainable expansion where people keep getting wage increases, they keep moving themselves back into position, and then their wages and their incomes catch up to the change in the price level. But for that to happen, we have to do two things. We have to bring inflation fully down to 2%, and we have to do it without disrupting the economy to the point that people lose their employment. So that's why these two things together are so important. And over time, in any inflationary period we've had, you see people, catch up over a period of time, but it doesn't happen immediately. Now, maybe a positive I can share with you is that we did, we do contact calls, and this was larger firms. What we're hearing is that they're still working on catch up for their workers, and so they recognize their workers fell behind in real wages, and so you ask, before the most recent wage data came out, you might ask, why do firms in a softer labor market, a slowing labor market, keep raising wages at, say, the average is around 3%? Why do they keep doing that? It's because they want to give a little catch up, right? And they want to make sure that their workers feel confident that they didn't get completely left behind in that. And that's how the labor market typically works. So that's what's happening now.
I know we're out of time. Do we have time for one more question? One more question. Thank you. All right, Carl.
I'm not sure you won't mind then. Carl Bonham, Executive Director at UHERO. And I just had you mentioned earlier that the inflation expectations were anchored.
Yes.
Which was impressive throughout this episode of inflation. But it makes me wonder why we haven't cut yet. And I'm not latching on to the last labor market report or anything like that, but we clearly have a labor market that is slowing, maybe weakening, and I mean, the trends are largely all towards continued weakening. Hopefully that's going to flatten out at some point, but there's no real evidence of that. At the same time, we've got these anchored expectations. We know there's a lag between monetary policy, even as market rates move by themselves. And I would argue that we've already achieved the inflation goal. You mentioned the 2.6% headline CPE. If you take out OER, you're at 2%. And I'm curious whether you think we should take out OER, maybe before the next cycle. And then I'll finish with one question. I wonder what your view is of the neutral rate, because my guess is that we're going to have restrictive monetary policy all the way through next year, unless we see some really big cuts.
I feel like I've been given a test when you teach. So, okay, I can do it. So, okay, so let's go to the policy rate and the economy. So, right now there's a difference between the level of activity and then projections about where you think it might go. We have a lot of clarity over the level of activity, which is how strong is the demand for workers, how strong is consumer demand, how good are incomes, all the things that we can talk about. And when you talk to businesses, they don't think that their business is weak, they just see it slowing. So then you get into, okay, what is the projection? But there we have considerable uncertainty. Now there's always uncertainty about the projection, but the uncertainty that we've been facing is even wider because we got that poor data on inflation earlier in the year, and that was when the talk emerged that maybe policy is not tight enough. Now I was never a proponent of that. It always seemed completely tight enough and very restrictive to me, but there was a lot of chatter about that. So that has passed. As I said, that's over. Now we're to a point about, is the labor market slowing a lot or slowing a little? As you see from the projections for the employment report, it did not have this. That's why everybody's surprised. But it also hadn't factored in Hurricane Beryl to the extent that disrupted activity, and didn't factor in the growth in the labor force, which was largely due to the inflow of immigration. So those are things that you don't know. So what is important though, and I'd say this is even more important than is it July or is it September, what's really important is, has the economy downshifted and did we recognize it? And if you look back at the FOMC statement and Chair Powell's press conference, you see the statement indicated we see it, and that Chair Powell indicated we recognize it, and that we're prepared to act as we get more information. And that is in part, I believe, why you see the labor market report translating into rate reductions of mortgage interest rates and other things, right? Is because they understand our reaction function, that we do, that it's clear inflation's coming down closer to our target. It's clear that the labor market is slowing, and it's to a point where we have to balance those goals. I remember I gave this talk in June, a speech at the Commonwealth Club in San Francisco, and I said, elevated inflation is no longer the only risk we face. And that got a lot of attention in the room, and in part it was because there was a sense that, yes, we've arrived at a place where inflation is now, I'm more confident that we're on a sustainable path to 2, and that labor market has to come back into frame. And that's why I said earlier, that itself, the communication itself, is a policy adjustment. And if you act when you don't know more, because with all this uncertainty, you can actually end up making a mistake. And it is just as, up until now, when you see that there could be potential weakness in the labor market, although I don't see it yet, really the risks they were just becoming balanced, right? The risk, because you don't want to leave inflation persistently above 2%. That would be, people have endured this interest rate environment just to leave inflation at 2.6. That's not a good outcome. And we don't want to tip the labor market over. So that's the world we're in right now. And as I said, it was a unanimous decision to leave it. And the communication that we do is, in my judgment, equally valuable.
All right, well, President Daly, thank you so much for taking time out of your schedule to join us here this morning. We know you have a busy schedule here, a short time in Hawaii, hopefully get to do some relaxing and a little bit of vacation while you're out here, but we appreciate you. And thank you all for being part of this conversation. And again, thank you to Hawaii Executive Collaborative for helping to organize and have us here today. Thank you all so much, and enjoy the rest of your day.
Thank you.
Aloha.
Thank you very much.